Hey guys, last Friday was SCHD's Reconstitution, and you know what that means? That means they are kind of shedding that fat and bringing in some good dividend companies. And that's just good news for you, because when we're looking at having a great ETF, sometimes we got to get rid of the players that aren't doing so well, and we got to bring in some better ones to kind of make this team a better and better team. Now, not always will it be a great thing to do. Maybe you have LeBron James on your team, and you trade him away to some other team. You're like, why are you doing this? But that's just part of having an ETF. ETFs are trying to create like a safe haven, a place where you don't have to pick and choose those individual stocks. And today we're going to be talking about a little bit about SCHD's Reconstitution. They got rid of about 17 different holdings, and they brought in 20 new holdings. What does that mean to you? Well, first of all, let's start off and let's get talking about SCHD and what it means to you. Hey guys, my name is Steve, and I run the Frugal Expat website, where we try to help people to save more and invest better. Today we're talking about SCHD and their Reconstitution. Now, SCHD, like I said in the past, even in the last couple weeks, I've been saying it's one of the best dividend ETFs to buy and hold. And it is true. I mean, they have historically had about 11% dividend growth rate. They have had a 3.5% yield, which is great because it beats a lot of the big players. And it also is quite stable. As we can see, the US market is going up and down because, maybe tariffs are going to go on to companies, or tariffs may come off. And so the market volatility is going up and down, and it's going crazy. But SCHD is built with some blue chip solid companies, and right now it is adding more and more solid companies. Now, some of these companies you may have heard of, like Merck or Target or General Mills, and so those companies are kind of some great blue chip stock companies that are coming in and kind of creating a great dividend yield, a great dividend growth rate, and keeping this ETF stable. So what we're going to do today, we're going to be talking about, some of the ins and outs, which companies are leaving, which companies are coming in, and what does this mean to you? Should you buy and hold? Should you continue to keep it, or should you kind of chuck it out? Well, that's what we're going to try to answer, and we're going to try to help you in this video. All right, let's get started. Now let's get to kind of a summary of what's going on with this ETF. So as we can see, SCHD has reconstituted, and this happened on Business on Friday, resulting in about 20 additions and 17 deletions. Now, they got rid of Pfizer and BlackRock, and some people may not like Pfizer, and that's okay. And some people may be kind of against some of BlackRock things that are going on. Well, now that just makes this ETF even a better place to put your money. And let's see, it added ConocoPhillips, and that has become one of its top holdings. And that's great because, when we're talking about bringing in some new things, and during this new administration, they said drill, drill, drill. Well, the energy sector is a great way to kind of keep your money safe, because as this volatility is going on, people may be escaping those growth stocks and growth ETFs and kind of putting into more stability, like energy and utilities. And those are just things that we're looking at. Now, SCHD has made that possible. Let's continue to look at what is going on with this ETF. So the total energy sector exposure is now up above 20%. And it reveals the new portfolios designed for high inflation years like 2022. And the index yield has dropped by 0.07%. Now, shareholders will probably earn about 3.81% at the current prices. Now let's take a look at the top 20 holdings that they've added. Like I said, they've added ConocoPhillips, they've added Merck, which is a great company and has been trading down recently for last year. That means they got it in a great deal. Target is down about 30% for the last year, and so that means they're getting a cheaper rate, plus their dividend yield is around 4%. That's amazing news to those that are now going to be holding Target in SCHD. They've got Halliburton, they've got a little bit, some financials, but more energy and some more just consumer staples. So what they're doing is they're kind of getting rid of some of those financials and kind of bringing in some energy, because they know that energy is going to be a bit more solid going forward. And we don't know what's going to happen in 2026 or 2027, but this is for 2025. This is just a great way to kind of start and build a more solid ETF. And as people are going to be leaving kind of those riskier sections, they're going to be coming in and finding more stability within SCHD. Now let's go over some deletions that are happening with this ETF. Now, like I said, they're losing Pfizer and BlackRock. They're losing a lot of financials. I mean, look at, there's this Bancorp, M&T Bank. There's so many different financials that they're losing. And, that's just not a bad thing. I mean, you're looking for something that's going to build, and you're going to kind of get rid of the losers and bring in some more winners. And that's just great news for you guys. Alright, so as we're looking at this as well, we're going to have a little bit of some bad news. Since we got rid of Pfizer, it was the top holding in this ETF, and that means we may be getting rid of some of the high dividend yield it's coming with. So right now, SCHD is going to go from about a 3.94% to 3.87%, making it about 3.81% due to the current prices. Now that's not that bad of a news. I mean, it continues to grow its dividend year upon year, and the great thing about this is it added some great companies like Target. Target is a dividend king. That means it has been paying dividends forever, for at least 50 years, and that is great news when we're looking at trying to have a good base of dividend stocks. SCHD makes it possible. And if we're looking at other stocks like DGRO, VYM, or FDVV, they're very heavily into some of these tech companies. And as the tech companies are kind of taking a spill, right now, SCHD is not. Is being stable, and that's good news, because if you are looking for kind of that risk and reward, it would be better to go for like a growth ETF like SCHG or even QQQ or VGT. Right now, if you're looking for more stability in a market downturn, it is better to go with maybe a good dividend ETF like SCHD. It holds steady and it allows you to continue to grow your portfolio when everything else looks like it's just falling down. Now, those are just a little bit about this reconstitution, and the thing is, we really don't know how well this is going to do over the year. Last year they got rid of Broadcom, and that kind of brought down so much hope and a lot and fervor for this ETF. People are like, why? Why would you get rid of Broadcom? Like I said, getting rid of LeBron James. But, after this year, you may be thinking, well, that may have been a good deal. But here's the thing, we don't know what's going to happen the rest of the year, but if you continue to buy and hold, this ETF is going to continue to create good dividend yields. It's going to continue to grow its dividend year upon year like it's done for 13 straight years, and it will continue to grow in performance. It used to beat the S&P 500 until that tech bull run in 2023 and 2024. So right now, it is a great ETF that has great blue chip stocks, great yield, and it's stable during market downturns. So what are you going to do today? Well, let me know. Are you going to continue to buy? Are you going to buy and hold? Or are you going to sell? To me, I'm going to continue to buy and hold and continue to create a great dividend snowball for my retirement. So until next time, we'll continue to create great videos to help you guys out. And check out my last video on what are the best dividend ETFs ranked best to worst right up here. All right, I'll catch you guys later. I'll see you.